Hi, everyone, and welcome. The team here at Pro Tax Accountant has put together this briefing to walk you through a really fascinating, high-stakes legal battle over inheritance tax in the UK. Now, this isn't just some dry legal case study. Oh, no. It's a story about some very clever planning, a huge challenge from HMRC, and a court decision that, honestly, was pretty surprising. It holds some massive lessons for anyone thinking about their own estate. So let's just dive right in. Let's kick things off with a big question, and I want you to really think about this. For most of us, our home is our biggest asset, right? It's more than just bricks and mortar, it's our life's work, the place we raised our family, it's the legacy we want to leave behind. But is that legacy, the very heart of your family's financial future, really as safe from inheritance tax as you think it is? Okay, so to get to the bottom of that, here's our roadmap. We're going to start with the basics of your home and inheritance tax, which is really the core of the problem. Then we'll get into this ingenious thing called the home loan scheme, which was at the center of this whole case. After that, we'll follow HMRC's big legal challenge, and then the surprising court ruling that nobody saw coming. And most importantly, we'll figure out what all this actually means for you and your own planning today. It's a bit complex, but I promise we'll make it super clear. Right. Let's set the stage. The main issue we're talking about here is inheritance tax, or IHT, in the UK. And when it comes to planning your estate, this is often the multi-million-dollar question. Because let's face it, for most families, their home is easily the most valuable thing they own. And that, of course, makes it the asset that's most at risk of getting hit with a massive tax bill when it gets passed on. To make this feel a bit more real, let's imagine someone. We'll call her Anya. She's a freelance graphic designer, she lives in London, and over the years, she's poured everything she has into her flat. It's not just a property, it's her life's work. So for her, this isn't just about taxes on a spreadsheet. It's about making sure that the value she's worked so hard to build can be passed on safely to her kids. Anya's situation, well, that's something millions of us can understand. And here's the number that makes people like Anya really start to worry. The standard inheritance tax rate on anything in your estate that's above the tax-free allowance is a whopping 40%. Just let that sink in, 40%. If Anya's flat is worth a good amount over that threshold, a 40% tax bill could literally force her kids to sell the family home just to pay HMRC. That's a huge financial hit, and an emotional one too, which is exactly why people look for expert advice on how to plan things out properly. So this brings us to a really clever solution that a lot of people, including a woman at the heart of our story, Mrs. Elborn, were looking at back in the early 2000s. Faced with that scary 40% tax rate, a strategy called the home loan scheme started to get popular. It was seen as a pretty ingenious way to shield the value of the family home from the tax man. We're going to look at her specific case to see exactly how this plan was meant to work. Okay, so here's how the scheme worked step by step back in 2003. First, Mrs. Elborn sold her house to a trust that she set up for her children. You can think of this trust as like a family safe deposit box that now legally owned the house. Step 2, instead of getting paid in cash, she got a loan note from the trust, which is basically a formal IOU for the full value of the house. Step 3, and this is crucial, she then gifted that IOU to a second trust, one that she herself could never benefit from. And finally, she just kept on living in her home, totally rent-free for the rest of her life. So on the outside, her life didn't change at all, but on paper, the ownership of her assets was completely different. And here's a little pro tip that explains the genius of that third step. That gift of the IOU to the second trust, that's what's known as a potentially exempt transfer, or a PET. Now, under UK tax law, if you make a gift like this and you live for another 7 years, that gift completely falls outside of your estate for tax purposes. It's like it never existed. Mrs. Elborn made this gift in 2003 and passed away in 2011, well over 7 years later. So her family argued that the IOU, which represented her home's value, was now totally IHT-free. Seemed like the perfect plan, right? But that's not all. Here's where the battle really began. Well, as you can probably guess, HMRC, the UK tax authority, took a very, very close look at this whole setup. From their point of view, this wasn't clever estate planning. They saw it as an artificial scheme designed for one thing and one thing only: tax avoidance. So they launched a full-blown legal challenge to get back the hundreds of thousands of pounds in tax they thought was owed. Now, HMRC built their entire case around one specific bit of law, Section 103 of the Finance Act 1986. You can think of this as one of their main weapons for fighting what they see as tax loopholes. It's a powerful anti-avoidance rule, and it basically says you can't just create a debt as part of a tax avoidance plan and then try to deduct it from your estate's value. And HMRC was convinced that this IOU from the trust was exactly that kind of debt. So the entire legal fight, everything, boiled down to this one single point of disagreement. HMRC's view was that the loan note was basically a personal debt of Mrs. Elborn's, and if that was true, then Section 103 kicked in and the value couldn't be deducted from her estate. Game over. But the estate's lawyers argued the complete opposite. They said, nope, the debt belongs to the trust. The trust is its own legal entity, not Mrs. Elborn. And if they were right, then Section 103 didn't apply, and the plan worked perfectly. The whole thing, the entire case hinged on that one question. Whose debt was it, really? So the case went to court, to what's called the first-tier tribunal. And in what must have been just a devastating blow for the family, the court sided with HMRC. They agreed the debt should be treated as Mrs. Elborn's personal debt. And just like that, it looked like the whole scheme had failed. It seemed like it was all for nothing. But stay with me. The next point might just surprise you. The family and their lawyers didn't give up. They were convinced the first court had interpreted the law incorrectly, so they appealed the decision. They took the fight to a higher court, the upper tribunal. And this is where the story takes a really dramatic twist, leading to the final verdict that I don't think many people saw coming. And here we go. The case lands in the upper tribunal. The judges there looked at every argument, every single piece of legislation all over again. They were ready to deliver their final judgment. This was it. This was the moment of truth for the Elborn estate, and it was a decision that was going to set a major precedent. And in a stunning reversal, the upper tribunal declared that the first court had, and I'm quoting directly here, made an error of law. Their final judgment was crystal clear. The note issued by the trustees was not a debt incurred by the deceased. The higher court completely agreed with the estate. The debt belonged to the trust, not Mrs. Elborn, and that meant Section 103 didn't apply. It was a complete, total victory for the family. The scheme, as it was designed back then, had actually worked. Now, when you hear about a huge victory like that, you might be thinking, wow, that's amazing news. I should set one of these up for myself. But hold on. This is probably the most important part of this whole discussion, so please listen really carefully. You can't. While the Elborn estate won their case based on the law from 2003, the government already changed the rules to stop anyone else from doing the exact same thing. This timeline tells the whole story perfectly. In 2003, Mrs. Elborn sets up her plan. But look what happens just 1 year later, in 2004. The government, seeing these schemes popping up, brings in a new law called the Pre-Owned Assets Tax, or POT. This law was specifically designed to kill these types of arrangements stone dead. So even though the court case was only won in 2025, the loophole that Mrs. Elborn used was actually closed way, way back in 2004. The court just confirmed that her plan was legal under the old rules. And here's a quick did you know for you. The creation of that pre-owned assets tax wasn't a coincidence. It was a direct, targeted shot fired by the government to shut down home loan schemes just like this one. It really just highlights that constant cat and mouse game between tax advisors trying to find legal ways to be efficient and the government, which is always trying to close what it sees as loopholes. Okay, so let's quickly recap the key takeaways from this incredible case. 1. The court confirmed that, legally, under the old rules, the scheme worked. 2. That tiny legal detail, the difference between a personal debt and a trust's debt, was absolutely critical. 3. And this is the big one for you, new laws like POAT mean this specific plan is no longer an option if you're setting something up today. And 4, it just proves that inheritance tax planning is seriously complex, and the rules are always, always changing. So what's the big lesson we can take from the Elborn case? It's that trying to navigate the world of inheritance tax on your own is probably not a good idea. The landscape is complicated, the laws are constantly being updated, and as this case shows, success or failure can literally depend on the tiniest legal details. This is exactly why getting professional, up-to-date advice is just so important. It really is about peace of mind. So if you're thinking about your own estate and you want to be sure you're navigating these issues correctly, the team at Pro Tax Accountant are specialists in this area. They can give you advice that is tailored to your specific circumstances. You can reach them directly on WhatsApp or give them a call on the number you see on the screen, 07985 689912, or just drop them an email at info@protaxaccountant.co.uk. And that really brings us to our final thought for today. The Elborn case is a powerful story and a great reminder that the rules of the game can and do change. So it leaves us with one final question for you to think about. What does your own inheritance plan look like right now? And is it ready to handle this ever-changing landscape? Thank you so much for joining us for this briefing. If you found this useful and you want more clear expert guidance to help you make sense of the world of tax and finance, then make sure you hit that subscribe button for the Pro Tax Accountant channel. We'll see you in the next one.